There is a quiet mechanism moving through the market right now, and most people do not see it because they are watching the wrong screen. They are watching the same large technology names, the same index, the same headlines, and the same daily noise. They think the market is one thing, up or down, good or bad, risk on or risk off. But that is not how money really moves. Money moves like a system. It moves from crowded places to less crowded places. It moves from popular stories to neglected assets. It moves from yesterday's winner to tomorrow's opportunity. And when that movement begins quietly, it often rewards the people who understand the flow before it becomes obvious to everyone else. That is what I believe is happening now. Capital is beginning to rotate out of the areas everyone talks about and into areas most retail investors almost never study seriously. If you miss that rotation, you can spend the next year watching an index go sideways, feeling like nothing is happening, while a small group of stocks move in a very different way. If you understand it, you do not have to gamble on meme stocks. You do not have to chase whatever is being screamed about on financial television. You can look at the world, look at the flows, look at the sectors, and make more rational decisions. That is the difference between reacting and thinking in principles. The market is not just a collection of tickers. It is a machine made of money, incentives, liquidity, crowd behavior, policy, debt, inflation, energy, geopolitics, and fear. Most people only see the price. The price is the last thing the system shows you. The causes usually begin earlier. So the real question is not what stock is moving today. The real question is, where is money being forced to go? That is the question I would start with. To understand that, you have to begin with the largest picture. You have to look at the macro environment, but not in the way most people look at macro. Macro does not have to become a guessing game where you pretend to know exactly what central banks will do, exactly where inflation will go, or exactly what happens next in geopolitics. I think of it more like weather. You do not need to predict the weather perfectly to dress properly. You need to observe what kind of weather you are already in. If the clouds are building and the wind is changing, you do not need to know the exact minute the storm arrives. You need to understand that the conditions are different from yesterday. The same is true in markets. In 2021, nearly everything went up. Liquidity was everywhere. Money was cheap. Speculation was rewarded. People thought they were geniuses because the environment made almost everyone look smart. That is not the environment now. Now people are worried about inflation. They are worried interest rates may not fall as quickly as they hoped. They are watching governments borrow and spend. They are watching central banks manage consequences. They are watching wars, energy markets, oil prices, supply chains, critical minerals, and national security concerns all interact at the same time. That sounds complicated, but the principle is simple. When the weather changes, different assets need different clothing. Some sectors do well when money is cheap and growth stories are all that matter. Some sectors do well when inflation is sticky. Some sectors do well when energy becomes more valuable. Some sectors do well when countries start worrying about security and supply chains. Some sectors do well when everyone else has been ignoring them for years. Your job is not to predict everything. Your job is to avoid being dressed for the wrong season. This is where many retail investors get trapped. They believe buying the index means they own the market in a balanced way. They believe they are spread across hundreds of companies. Technically, that may be true. Economically, it is not that simple. The S&P 500 is built by market capitalization. The larger a company is, the larger its weight becomes. So when money goes into index funds, more of that money automatically flows into the biggest companies. That creates a flywheel. The biggest companies get more money because they are the biggest. Then they get bigger. Then their weight in the index grows. Then even more passive money flows into them. The machine feeds itself. It is not evil. It is not a conspiracy. It is simply how the system is designed. But if you do not understand the design controls you. If a company like Microsoft or Amazon or Nvidia is many times larger than a smaller company in the index, passive buying sends many times more money into that larger company. Pension funds do it, retirement accounts do it, ETFs do it, many investors do it without thinking about the consequence. Over time, the index becomes more concentrated. A relatively small number of companies can come to represent an enormous part of what people believe is a broad market. In the source argument, the top names represent an unusually large share of the index with a concentration that invites comparison to earlier periods of market stress. The point is not that concentration must immediately collapse. The point is that concentration changes the risk profile. When those mega-cap stocks rise, index investors feel diversified and smart. When those same stocks stop leading, the index can become heavy. It can move sideways. It can disappoint. It can hide the fact that money is quietly moving somewhere else. That is why I never want to look only at the index. The index tells you where the crowd already is. It does not always tell you where the next flow is going. A lot of sophisticated investors understand this. If they want mega-cap exposure, they may choose concentrated exposure deliberately that can be rational if it is done consciously. But many retail investors are concentrated without knowing they are concentrated. They think they are diversified because they bought a broad index, when in reality a large portion of the risk is tied to a handful of very large companies. That does not mean those companies are bad. It means you need to know what you own. Markets punish people less for being wrong than for not knowing what game they are playing. The mistake I see again and again is that people wake up, open the news, look at the S&P 500, then stare at the same large stocks everyone else is staring at. They ask, what is moving today? They look at the most crowded names in the most crowded conversation and think that is investing. But educated money behaves differently. It rotates. It moves from mega caps to beaten down sectors. It moves from technology to energy. It moves from popular trades to unloved trades. It moves from expensive assets to cheaper assets. It moves from crowded places to uncrowded places when the conditions justify it. That movement is not random. It follows incentives. When inflation changes, money changes. When oil changes, money changes. When government policy changes, money changes. When energy security becomes more important, money changes. When supply chains become strategic rather than purely economic, money changes. Your job is not to guess which mega cap stock everyone will love next week. Your job is to follow the money. That phrase sounds simple, but it is one of the deepest principles in markets. Price is the outcome of buying and selling. Buying and selling come from flows. Flows come from incentives, fear, policy, liquidity, and expectations. If you can understand where those forces are moving, you can stop behaving like a spectator and start thinking like a decision maker. The way I would approach it is not to start with stocks. That is very important. Most people start at the bottom of the pyramid. They ask, what stock should I buy? That is usually the wrong first question. A stock is just one expression of a much larger system before I look at the individual company. I want to understand the environment, then I want to understand the sector. Only then do I want to understand the individual leader inside that sector. The process begins with a weather report. Where are we in the world right now? Are we in a cheap money boom? Are we in a sticky inflation period? Are rates falling or staying high? Is energy scarce or abundant? Are governments spending aggressively? Are countries worried about supply chains? Are wars and sanctions changing trade routes? Are commodities becoming strategic? Are data centers changing demand for power? You do not need to become a professional macroeconomist. You do not need to predict every number. You simply need to know what kind of world you are investing in. After that, I would look at sectors. Which sectors are receiving money? Which ones are breaking out? Which ones have tailwinds that are not yet obvious to the crowd? Which ones are being supported by policy? Scarcity, inflation, infrastructure spending, or national security? Which ones have been ignored for long enough that a change in flows can create a powerful move then? And only then I would look for the companies inside those sectors. That is the part most people want to jump to. They want the ticker first, but if you start with the ticker, you are starting with the most fragile piece of information. A ticker without context is a temptation. A ticker inside a sector, inside a macro environment, inside a flow of money is a different thing. That is the framework. Understand the weather, rank the sectors, find the leaders. It works because it respects how systems move. It can work in bull markets, sideways markets, difficult markets, political markets, inflationary markets, and uncertain markets because it is not based on needing one perfect forecast. It is based on observing flows and probabilities. One of the sectors where the flow becomes interesting is the energy equipment and services area. I do not just mean the companies that produce oil and gas. Those are the obvious names. I mean the companies that provide the equipment, infrastructure, tools, services, compressors, drilling support, pipeline support, and complex machinery that make the energy system operate. In a gold rush, the obvious story is the miner. But many times the steadier way to think is to look at the people selling the picks and shovels. Energy has its own picks and shovels. If the world needs more energy, someone has to drill, transport, process, liquefy, store, repair, and maintain the infrastructure. If artificial intelligence requires enormous power, that power has to come from somewhere. If energy security becomes more important, countries need more redundancy. If conflict threatens shipping routes, governments and companies rethink infrastructure. If oil prices rise, producers in safer regions have more incentive to spend. That spending does not only benefit producers, it can benefit the machinery and service companies that support the whole system. That is why this sector matters. The source argument points to oil and gas machinery, energy infrastructure, and LNG. Related build-out as an area where money has been rotating. That makes sense as a system. Liquefied natural gas requires terminals, pipelines, equipment, compression, specialized services, and long-cycle capital spending. Energy security requires storage, transport, redundancy, and repair. Higher energy prices can lead to more activity in regions that are considered safer or more reliable. Again, the principle is not to buy anything blindly. The principle is to ask, where does the spending have to go if this macro environment continues? One name in that system is Baker Hughes, BKR. I would think about it as a picks and shovels company for oil and gas. It is not just a simple oil price bet, it is connected to the machinery and services required to produce and move energy. When the world needs more LNG, more offshore capability, more maintenance, more drilling infrastructure, and more resilience, companies like this can enter the conversation. What matters to me is not just the story. A story can be persuasive and still be a bad entry. I want to see whether the market is confirming the story. I want to see whether the stock is building a base. I want to see whether it has been moving sideways, absorbing supply, and then beginning to break above prior highs. I want to see volume because volume gives clues about whether larger participants are involved. This is where many investors make the opposite mistake. They say, if I like the company, I should buy it cheaper. That sounds logical at first, but in markets, cheap is not always better. Sometimes a stock is cheap because money is not ready to move into it. Sometimes the better probabilistic entry is when a stock proves strength by breaking above a level where sellers previously stopped it. This is not about overpaying emotionally. It is about paying a little more after confirmation. Institutions often think this way because they manage risk through probabilities. They do not need to buy the exact bottom. They need a repeatable process. A breakout after a base can be more useful than an apparently cheaper price with no confirmation. The goal is not to be clever. The goal is to improve the odds. So if I see a stock like BKR build a range, press against prior highs, and begin to move through them with strong activity, that is more interesting than simply saying the company is in the right sector. The sector gives me the reason to look. The chart and flows help me decide whether the market agrees. Another name in the same broad energy infrastructure world is NPK. It is a smaller company connected to temporary worksite infrastructure for energy and construction projects. Smaller companies can move more sharply, but they also carry more risk. That is why I would be even more careful about process, position sizing, and entry discipline. The source argument notes that this type of company can benefit when energy and construction activity require support infrastructure. It also points to institutional ownership and analyst interest as reasons it is worth watching. I would not treat those as a command to buy. I would treat them as reasons to put it into the research process. The same pattern applies. I want to see whether the stock has formed a range. I want to see whether it has stopped going down. I want to see whether the lows are stabilizing. I want to see whether it can break above a previous zone of resistance. I want to see whether volume supports the move. The market often moves in pulses. It rises, rests, digests, and rises again. Or it fails. The resting phase matters because it tells you whether early buyers are still holding and whether sellers are being absorbed. When a stock goes sideways after a meaningful move, that can be a sign of preparation. But it is only useful if the next move confirms it. This is why I do not want to chase randomly. I want a thesis, a sector tailwind, and a technical confirmation. That combination does not guarantee anything. Nothing in markets does. But it is better than buying because someone on the internet gave you a ticker. The second sector that matters in this framework is critical minerals, mining, and related materials. This may sound boring. That is often a good sign. Many of the best opportunities begin in areas people find boring until prices start moving. By the time everyone finds them exciting, the easy part may already be gone. The world is becoming more electric. Electric vehicles need minerals. Batteries need minerals. Solar and wind need storage, and storage needs minerals. The grid needs modernization, and that requires materials. Defense applications require specialized inputs. AI data centers require power, cooling, infrastructure, and hardware. And that creates demand through the supply chain at the same time. Countries do not want to depend on rivals for strategic minerals. That changes the nature of demand. When a material becomes strategic, it is no longer just a commodity. It becomes part of national security, industrial policy, and geopolitical competition. Governments become involved, financing becomes involved, domestic supply chains become important, the flow of capital starts to change. The source argument points to major financing support for domestic mineral supply chains. The exact number is not the most important part of the principle. The important part is that when governments decide an area is strategic, capital can move in a way that lasts longer than a simple trade. That is why I would study critical minerals. One company mentioned is SQM, Sociedad Química y Minera de Chile. one of the major lithium producers. Lithium is tied to batteries, and batteries are tied to electric vehicles, storage, and the electrification of many parts of the economy. The company has operations and partnerships that connect it to future capacity. But again, the company's story is not enough. I would ask, what is the price doing? If a stock has been moving sideways and then begins to break above an important prior level, that can be the market telling you the story is starting to matter again. In the source structure, the interesting area is not buying weakness blindly. It is waiting for the price to move above a previous high, even if that means paying more than the current quote. That sounds strange only if you were taught that investing is always about buying lower. In reality, investing and trading are about probability, risk, and time frame. Buying lower can be right if you are valuing a business over a long period and have high conviction. Buying higher can be right if you are following institutional momentum and want confirmation that money is actually entering. Different games require different rules. This is why people get hurt. They mix strategies, they use a long-term value phrase to justify a short-term trade, or they use a momentum signal to justify owning something they do not understand. The result is confusion. Clarity begins by knowing what decision you are making. If I am following sector rotation, I want confirmation that the rotation is real. Another company mentioned is Uranium Energy Corp, UEC. Uranium is connected to a different but related theme, power. The world is demanding more electricity. AI data centers add to that demand. Governments want reliable baseload power. Nuclear energy, whatever one thinks politically, becomes part of the discussion because it can produce large amounts of power with different emissions characteristics than fossil fuels. The source argument points to new uranium production in the United States and the desire for domestic supply rather than dependence on foreign sources. That is an important pattern. When energy security and national security overlap, the investment conversation changes. But I would not simply say, uranium matters, therefore buy the stock. That is too simple. I would look at the chart. I would look at whether the stock has rallied, corrected, and then formed higher lows. Higher lows can be a clue that selling pressure is weakening. I would look for a reversal structure. I would ask whether it is still too early or whether the signal is strong enough. Sometimes the right answer is not buy, sometimes the right answer is watch. That is a very underrated decision. Most people think investing means always doing something. Often, the best action is to prepare, build the watch list, understand the thesis, know the levels, know the risk, then wait for the market to show whether the idea is ready. Patience is a position. The third name mentioned in the critical minerals and rare earth area is CMP. Again, the logic is similar. The world needs more of certain materials, supply chains matter, governments care, industrial systems require inputs, but an individual company still has to earn its place in the portfolio. The source structure looks for a possible breakout above a prior level, with interest only if the price rises enough to confirm strength. That may seem counterintuitive, but it is consistent with the institutional style of following money rather than trying to catch every bottom. This is the core lesson. The stock market is not one thing. It is a chessboard of sectors. Software can be crowded while energy services are improving. Mega-cap technology can rest while uranium begins to form a base. The index can look tired while certain industrial, mineral, energy, insurance, healthcare, defense, or electronic component groups are receiving money. The news compresses all of that into one sentence. The market was up today. The market was down today. That is not enough. The deeper truth is that money rarely disappears all at once. It often moves. It moves from one square on the board to another. If you only watch the whole board from far away, you miss the migration. A market can feel dead on the surface while opportunity is moving underneath. That is why sector rotation matters. But sector rotation must be handled responsibly. It is not a license to chase every chart. It is not a reason to put a large amount of money into something you do not understand. It is not a substitute for risk management. The first principle is position sizing. I never want one idea to have the power to damage my life. That is not investing, that is emotional dependence. If a position can make you unable to sleep, the position is too large or the plan is too weak. One way to think is to define the maximum loss before entering. The source argument uses the idea of limiting risk from the portfolio bucket, such as building positions so the loss is capped at a small percentage if the idea fails. The exact number depends on the person, the strategy, the time frame, and the account. The principle is what matters. Define the risk first. Most people define the dream first. They ask, how much can I make? The better question is, what happens if I am wrong? Because you will be wrong sometimes. I will be wrong sometimes. Everyone is wrong. Sometimes the market is a humbling machine. It teaches by taking money from people who believe certainty exists. There is no certainty. There are probabilities, risk controls, and decisions made under uncertainty. That is why I like frameworks. A framework does not make you omniscient. It makes you less impulsive. It gives you a way to see the world when headlines are trying to make you emotional. When I look at this current environment, I see a world that is not like 2021. I see a world where passive concentration has changed index risk. I see a world where energy, infrastructure, critical minerals, AI-powered demand, domestic supply chains, and geopolitical security are becoming more important. I see a world where money can rotate into areas that many retail investors have not studied. That does not mean every company in those sectors will work. It means those sectors deserve attention, and attention is the beginning of opportunity. If you are a retail investor, the big danger is not only losing money. The big danger is thinking the market is simple because your app makes it look simple. You see a green button and a red button, you see a chart, you see a headline, you see a ticker trending, but behind that simple screen is a complex system. There are pension flows, ETF flows, hedge fund rotations, commodity shocks, government policies, rate expectations, debt cycles, war risks, supply chain incentives, corporate capital spending, institutional constraints. You do not need to know all of it perfectly, but you do need to respect that it exists. That respect changes your behavior. Instead of asking for stock tips, you ask what environment you are in. Instead of chasing a headline, you ask where capital is rotating. Instead of buying because a sector sounds exciting, you ask whether the money is already confirming the thesis. Instead of betting too much, you define the loss. Instead of needing to be right today, you build a process that can be repeated. That is how you survive long enough to benefit when you are right. The market rewards survival first. Then it rewards insight. Then it rewards discipline. Most people want the reward without the discipline. That is why they move from one hot story to another. Always late, always emotional, always blaming the market. But the market is not there to make you comfortable. It is there to clear prices. So I would think about this current opportunity in a very sober way. There is a quiet rotation taking place. The index may not tell you the whole story because the index is heavily shaped by the largest stocks. Passive flows have made that concentration more important. Mega cap strength has been rewarded, but if leadership changes, many people will not know what is happening until later. Institutional money is always searching for the next place where risk and reward look better. Right now, the source argument points toward energy services and critical minerals as areas where the incentives are improving. Energy services can benefit from power demand, LNG infrastructure, oil and gas activity, geopolitical stress, and the need for resilient infrastructure. Critical minerals can benefit from electrification, batteries, grid upgrades, defense needs, AI data centers, uranium, lithium, rare earths, and domestic supply chain policy. Inside those sectors, names like BKR, NPK, SQM, UEC, and CMP become research candidates, not commands candidates. That distinction matters. A ticker is not a conclusion. It is the beginning of work. You look at the thesis, you look at the sector, you look at the balance of flows, you look at the chart, you look at the levels, you look at whether money is entering, you decide what would prove the idea wrong. You size the position so being wrong is survivable. Then you act only if the setup fits your principles. That is a very different way of behaving from the retail habit of buying because something sounds convincing. Convincing stories are everywhere. Good processes are rare. The process I would use here is simple enough to say in plain language. Look at the weather. Look at the sector flows. Look at the leading stocks. Wait for confirmation. Size the risk. Follow the money. Leave when the money leaves. That last part is important if you are using a rotation framework. You cannot fall in love with the theme forever. Themes change, capital moves, leadership rotates. A sector can be right for a period and wrong later. The goal is not to marry the story. The goal is to understand whether the flow is still there. When the flow leaves, you do not argue with it. You leave with it. That is one of the hardest things for human beings to do because we like stories. Once we understand a story, we become attached to it. We want it to keep being true. We want to defend it. We want to feel smart. Markets do not care about that. The market cares about supply and demand, so the discipline is to keep updating. If energy services keep receiving money, the thesis remains alive. If critical minerals begin breaking out with volume and leadership broadens, the thesis improves. If the breakouts fail and money rotates elsewhere, the thesis weakens. That is not personal. That is information. The best investors I know are not the ones who never change their minds. They are the ones who change their minds for the right reasons. They do not flip because of emotion. They update because of evidence. That is what I would want you to take from this. You do not need to be smarter than everyone. You do not need secret information. You do not need to predict the Federal Reserve perfectly. You do not need to know every geopolitical outcome. You need a way to observe the system more clearly than the crowd. Most of the crowd is watching price after the fact. You want to watch flows before the story becomes obvious. Most of the crowd is watching the index. You want to see the sectors underneath it. Most of the crowd wants a stock tip. You want a process. If you can spend even one serious hour a week doing that, you will already be behaving differently from most people. Review the macro weather, look at which sectors are strengthening. Compare them against the sectors everyone is already crowded into. Build watch lists, mark the levels where confirmation would matter. Decide the risk before the trade exists. Then wait, that is not glamorous. But most good investing is not glamorous. It is a disciplined effort to avoid obvious mistakes and put yourself in the path of rational opportunity. The greatest danger in markets is not complexity. The greatest danger is false simplicity. It is believing that because something is easy to buy, it is easy to understand. It is believing that because an index is diversified by name, it is diversified by risk. It is believing that because a stock is cheaper today than yesterday, it is a better decision. It is believing that because everyone is talking about one sector, that is where the next opportunity must be. Often the next opportunity is where people are not looking yet. It is in the quiet sectors. It is in the infrastructure behind the obvious story. It is in the picks and shovels. It is in the materials without which the big technology dreams cannot function. It is in the companies that make the system possible while the crowd argues about the visible winners. That is why I want to think in layers. The first layer is the headline. The headline tells you what people are emotional about. The second layer is the sector. The sector tells you where capital may be moving. The third layer is the company. The company tells you how the theme becomes investable. The fourth layer is the setup. The setup tells you whether the timing and risk make sense. Most people stop at the headline. That is why they are late. I would rather be early in understanding and patient in execution than late in both. So when I look at energy services, I am not simply saying oil is up or oil is down. I am asking whether the world needs more energy infrastructure, more LNG capacity, more drilling support, more maintenance, more resilience, and more secure supply. If the answer is yes, companies that provide the tools and services may become more important. When I look at critical minerals, I am not simply saying lithium or uranium or rare earths are fashionable. I am asking whether electrification, batteries, defense, grids, AI power demand, and domestic supply policy are creating durable demand for the inputs. If the answer is yes, the sector deserves study. When I look at BKR, NPK, SQM, UEC, or CMP, I'm not saying any of them must be bought. I am saying they are examples of how a macro thesis becomes a watch list. The watch list becomes a set of levels. The levels become possible decisions. The decisions become positions only if risk is controlled. That is a very different order from the one most people use. And order matters. In life and markets, doing the right thing in the wrong order can still produce a bad result. If you buy the stock before understanding the sector, you can be shaken out. If you understand the sector but ignore the chart, you can enter too early. If you enter correctly but size badly, one mistake can hurt you more than it should. If you size well but refuse to exit when the flow leaves, you can give back the gain. The system has to work together. That is why I keep returning to principles. Principles exist because emotions are unreliable. In markets, your emotions will tell you to buy after something has moved too far and sell after the pain has already happened. Your emotions will tell you that a popular stock is safe because everyone owns it. Your emotions will tell you that an unpopular sector is dangerous because nobody is talking about it. Sometimes the opposite is true. Crowding creates its own risk. Neglect creates its own opportunity. But neither crowding nor neglect is enough by itself. You still need evidence. That is the balance. Be open-minded about ignored sectors, but do not be careless. Be skeptical of crowded sectors, but do not assume they must fail. Watch where the money goes. Watch whether price confirms the thesis. Watch whether the move has institutional character. Watch whether the risk can be defined. If you do that, you start to see the market differently. You stop thinking the market is up or down. You start thinking which part of the market is being accumulated, which part is being distributed, and which part is being ignored. That is where the opportunity lives, not always in the story people are talking about, but in the movement of capital underneath the story. There will always be something to fear: inflation, rates, debt, government spending, war, oil, supply chains, currencies, elections, recessions, bubbles, crashes. If you wait for a world with no uncertainty, you will never invest. But if you ignore uncertainty, you will eventually pay for it. The answer is not fear. The answer is structure. Structure means knowing the weather. Structure means ranking the sectors. Structure means watching the leaders. Structure means demanding confirmation. Structure means managing position size. Structure means being willing to leave when the evidence changes. That is how I would think about this moment, not as a guarantee, as a setup. The market is telling us that the old easy environment is gone. The biggest companies can still be strong, but the index is more concentrated than many people realize. Passive money can keep feeding winners until it does not. When leadership changes, people who only watch the old leaders can miss the new rotation. At the same time, the world is demanding energy, infrastructure, minerals, power, resilience, and security. Those are not abstract ideas. They require real companies, real equipment, real materials, real capital spending, and real supply chains. That is where I would look. Quietly, systematically, without excitement, without panic, because the goal is not to sound smart, the goal is to make better decisions. If this framework is useful, the most important sentence is simple. Follow the money, not the noise, not the headlines, not the crowd. Follow the money, but do it with principles. That is how you avoid being trapped in a sideways index while capital moves somewhere else. That is how you avoid mistaking concentration for safety. That is how you avoid chasing tips and start building a process. That is how you give yourself a chance to participate in the next rotation without turning investing into gambling. And that is the kind of thinking that matters most in a world where the weather has already changed.